Relative valuation is a the relative valuation is a technique to value and estimate a stock value based on relative ratios such as price multiples and financial ratios. So the value of the firm or the value of a stock can be determined by comparing those ratios to similar peer stocks based on this, price multiples or relative ratios. And relevant variables include earnings, some earnings ratios and cash flow ratios, and book value ratios and sales ratio. The most popular relative valuation technique is based on the price to earnings or price to book value. So in general and mostly, the price to earnings, price to book value of equity, the price to cash flows. So the price to earnings, price to cash flows, the price to book value of equity, and the price to sales. These four ratios are common techniques mostly used, and especially this PER, PCF, and price to book ratio, and price to sales. Among these four ratios, this price to earnings ratio and the price to book ratios are most simple and popular multiples that investors take to value a firm. Okay, the price to earnings ratio, we call it a PER. This values the stock based on expected annual earnings. So the price to earnings ratio or earnings multiplier is the current market price divided by some annual earnings, which is the annual net income. And this ratio indicates that how much the investors are currently valuing as stock price relative to net income. So say if the PER ratio is 10 times higher than its earnings, it means that the investors are valuing the stock price as 10 times higher than its net income. If the stock price to earnings multiple is higher than its peers or higher than its own past average, so there are three ways to compare this ratio. First, you compare this ratio with its peers, or you can compare the ratio with its own past average. And lastly, you can compare this ratio with its industry average. Okay, suppose this earnings ratio is higher than its peers or higher than its own past average or higher than its industry average. It may indicate that the current stock price is overvalued, expensive, if all other things are equal. Okay, if the ratio is higher and if all other things are equal, it indicates that the current price is overvalued, expensive. However, it doesn't necessarily suggest that it is really expensive, because there is some difference in average multiples by industries. say manufacturing industry PER has an average value of say 10 times, while software, internet industry has an average multiple of 20. So you cannot compare this ratio with different industry. So it is important to compare this ratio with its peers in the comparable industry. Say if you want to compare the price to earnings ratio of Samsung Electronics, you should compare with its own past average or with its industry average, IT industry, or with its peers, say SK Hynix. Suppose Samsung Electronics has PER ratio of 10 and SK Hynix is 15. If all other things are equal, Samsung's stock price can set to be undervalued because the investors, the market is undervaluing the stock relative to SK Hynix earnings. But there may be some reason why the stock price of Samsung is undervalued or have low multiple, low ratio. So you have to question yourself why investors are valuing a pricing low for Samsung. Is there any bad things happening for Samsung? So to do this, you may simply look for its business outlooks and look for financial ratios of Samsung. We have learned in our previous section to find out the reason for this undervaluation. If there is no problem at its outlooks and if it has strong financial ratios, you can conclude that the low price earnings ratio of Samsung is indeed undervalued. And this is also the same for high multiples. Say overvalue situation. If Samsung has higher PER multiple, you have to look for why. If Samsung has better outlook than its peers, and if it has better financial ratios, then the high price multiples may be justified to be overvalued or to be expensive. If not, it may said to be overvalued. Okay, if Samsung has higher PER ratio than its peers or than its industry average, you may look for why. If Samsung has better business outlooks and better strong financial ratio than its peers, then this higher PER can be justified. So, although Samsung has higher PER ratio, you cannot say that the Samsung is overvalued. If Samsung's outlook is not really that good and the financial ratios are not that strong, but in this case, if Samsung has higher price to earnings ratio, you can say that this Samsung's multiple is overvalued. Okay, so unlike absolute valuation such as a dividend discount model or discounted cash flow models, the relative valuation techniques needs your judgment. Okay, there is no answer. So whereas the number from absolute valuation provides clear judgment rules to decide either over or under valuation, the numbers in relative valuation does not provide clear rules. It needs your individual judgment. Okay, price to cash flow ratio. Companies can manipulate accounting earnings, say accounting accounting earnings such as net income, for instance, by accelerating or delaying revenue and expenses. So cash flow is more accurate measure to decide how much the stock price is valued relative to its earnings. So the cash flow is less prone to manipulation. So this is important for fundamental valuation and in credit analysis. So the prices to cash flow ratio is to stock price divided by some cash flow measures. So higher the ratio, higher likelihood of overvaluation. But similarly, you have to look for why. Why, the reason why for higher ratio or lower ratio. If there is some reason why the higher multiples can be justified. If not, the higher ratio is not justified, so you can say overvalued or undervalued. So it needs your judgment. Okay, the price to book value ratio, the book value of equity ratio. Okay, so the PBR or the price to book ratio implies that how much the stock price is greater than its book value of equity. When comparing two stocks with similar growth and profitability, the PBR ratio can be useful for determining which is the best value at a given moment. So same as a price to earnings ratio, you have to look for the reasons why this PBR ratio is high or low relative to its peers, or relative to its industry average, or relative to its own past average, for instance. Okay. So this is kind of a market value of equity divided by a market book value of equity. Okay, in general, the lower the company's PBR ratio, the better the value it generally is. So if the market value, the PBR ratio less than 1 indicates that the market value is less than its book value. So it's undervalued. So this can be especially true if a stock's book value is less than 1, okay? Meaning that it trades for less than the value of its asset, sometimes called a liquidation value. So liquidation value is that if the firm goes default, then the firm has to sell its asset to pay back for its investors. So it's called a liquidation value. This is almost same as the book value. So say buying a company stock for less than book value, which means the PBR ratio less than 1, can create a margin of safety for value investors because the market value is less than its book value. However, a very low PBR ratio can also be a sign of trouble at a company. So you have to look for why. So it should be used as part of a thorough stock analysis. So if the company's PBR ratio is less than 1, it can indicate that it's really undervalued, or at the same time, it can suggest that company has really a big problem. So you have to conduct a deeper analysis to find out why. Okay. In normal situation, the market value is always greater than its book value. right? Since if you buy some asset, say if you buy some item, there is an inflation. So market value will always have to be greater than its book value in normal situation. So less than 1 PBR ratio might in the indication of some trouble. Okay. Okay. Lastly, the price to sales ratio. The sales measure is subject to less manipulation than other financial data as earnings and so on. And the sales varies dramatically by industry. So, of course, profit margins also vary by industry. So relative comparisons using price to sales ratio should be between firms. So within the same industry. Okay, so the higher the price to sales ratio, a higher likelihood that the current stock price of a firm is overvalued. But again, you have to look for why. Okay, does the higher or the lower ratio justify it? So you have to question yourself like that. Okay, overall, in this section, we have learned about two approaches. There were two investment approaches. First, top-down, and second, the bottom-up. Okay, two methodologies for stock valuation were absolute valuation, such as discounted cash flow model and dividend discount models, and the relative valuation using multiples such as price to earnings ratio and price to book ratio, price to cash flow ratio, and price to sales ratio. Okay, for absolute valuation for DCF and DDM models, two inputs must be estimated or to be assumed. First, a growth rate, and second one is the discount rate. And the long-term sustainable growth rate can be estimated as the return on equity times a retention ratio. Retention ratio is equal to 1 minus a payout ratio. And the discount rates were either a weighted average cost of capital if you use a free cash flow to the firm as a earning measure, or cost of equity if you use earning measure that is attributable to stockholders only. So cost of equity is the required rate of return estimated by a capital asset pricing model. So to value, to use a DCF or DDM, you have to make some assumption for the discount rates. So if you use some earning measure as net incomes or dividends as an earning measure, you have to discount it by a cost of equity, because these measures are only distributable to stockholders. Rather, if you use a free cash flow to the firm, such as operating profit, you will have to discount it using a weighted average cost of capital, because this operating profit is both distributable to bondholders and stockholders. From this operating profit, you pay out interest and you pay out dividend. So the operating profit is of both bondholders and stockholders. Okay. And lastly, the free cash flow to the firm is a cash flow measure that measures its earnings, because accounting earnings has some non-cash expenses or non-cash revenues, we adjust to measure the exact earning, exact cash flow of the firm. So the free cash flow to the firm is the after net operating profit after tax, such as operating profit, the earnings before interest and taxes by times 1 minus t, which is net operating profit after the tax, plus some, you have to add back some non-cash expenses such as depreciation and appreciation, and you have to add back the increase in net working capital. This is net working capital as a current asset minus a current liabilities. So if you have some if you have a lot of, say, suppose you have account receivables, so you made sales by receivables, the current asset will be increased, so the net working capital will increase too. So you have to adjust for this net working capitals to measure the cash flows. And finally, you have to adjust for capital expenditure called a capex. Okay, so measuring the free cash flow to the firm is not important in our class. Okay, so in the exam, I will not ask you to estimate the free cash flow to the firm. So you don't have to remember this formula. Rather, I will just give you the number. Say, I will give you the number for the free cash flow. So you may have to use this number to value a stock using a discounted cash flow model, right?